Hello everyone, and welcome to another episode of Investor Insights. I'm Madeline, Investment Advisory Director at iFAST Global Markets. And joining me today is my co-host Marcus, Senior Investment Consultant at iFAST. We are also thrilled to have a special guest in the studio, Andre De Sotel, Senior Managing Director Partner and Equity Portfolio Manager at Wellington Management.
In this episode, we'll be talking about the United Global Durable Equities Fund. Many investors are curious about how the fund is managed, how it's being set apart from its competitors, and how it can perfectly fit into a diversified portfolio. So with that, let's start. Andre, maybe you can give us a quick introduction of yourself. What is your investment style and the broad objectives of the fund itself?
Sure. So thank you for having me here today. I've been a global equity investor for about 30 years now, about 20 of those years at Wellington. And I'm one of the co-portfolio managers of the Durable Enterprises strategy. So my investment style is very rooted in my own personal experience as an investor. So very early on in my career, 25 to 30 years ago, I started as an investor and trader of Asian equities. And I remember very clearly in my career spending hours in the middle of the night in the eastern part of North America trading Asian equities. And I remember trying to sell our holdings in want holdings and it taking months at a time because liquidity had dried up. I also remember very early on in my career covering TMT stocks, tech bubble of the late 90s, early 2000s. And those early experiences really shaped who I've become as an investor. I've always cared since that time a lot more about what can go wrong with an investment versus what can go right. And I've cared much more about stability and resilience of companies and our investments than trying to chase high growth. And so my investment style is one that's rooted in conservatism, skepticism, and the goal is always to both protect capital and then build it over time. So the objective of the fund is to generate investment returns of 10% per year over the long term, and to do so with a lot less risk than the broader market. And so we run a very concentrated portfolio with a very long-term focus of companies that are usually much less cyclical than the broader market. And it's through that approach that we try and both build capital, but also preserve it in more difficult times.
It is interesting that you prefer a more stable investment approach. Would you be able to explain more about the types of profiles of companies that you might consider investing in order to help achieve a less volatile outcome for your portfolios?
Sure. So we buy companies that exhibit low economic sensitivity and low industry cyclicality, and that are able to deliver 10% value creation per year. And for us, value creation is earnings growth plus shareholder returns. So think of industries like personal insurance, food distribution, waste collection, or other essential business services. So industries and companies that generally have a fairly low range of outcomes. And the companies we invest in have to meet, for us, 4 criteria that's particularly important. So the first one is stability and resilience. So there we care a lot about the stability of the company, the stability of their free cash flow, of their earnings, of their returns on capital. The second factor is the people running those companies. So we look for management teams that exhibit humility, precision, and have a really good track record around capital allocation and operational performance. The third criteria is the price we pay for them. So we seek to buy companies that have moderate valuations and moderate expectations around them. And the fourth criteria, tied to the overall objective of the portfolio, is companies that can deliver at least 10% value creation per annum. And again, that's just a function. For us, value creation is the earnings growth plus the dividends that are paid to shareholders every year.
Thanks, Andre, for sharing a bit more of the type of companies you look at. With a very differentiated approach, how does it set you apart from the managers in the broader market? And with a differentiated approach, how is the portfolio ran to be able to deal with the current uncertainties in the world right now?
Yeah, sure. So that's a good question. So, we have an absolute return objective. And I think that's one of the first things that sets us apart from others. So, and we're very comfortable buying, for lack of a better word, boring, but high quality companies that for some investors might not grow fast enough, or for other investors might not be cheap enough. But we find a lot of attractive risk return opportunities in that middle ground. So I think that's one of the other things that we do a little bit differently. And we also impose on ourselves low turnover. And so that, for us, that means we really have to be looking out very long term, beyond what a typical investor looks at. So we're looking out, more than 4 or 5 years to try and look for that stability. So those are some of the things we do that I think allows us to play a slightly different game than a lot of portfolio managers.
And how does it help to deal with uncertainties in the current world?
I mean, the profile of companies we're trying to invest in have generally a low range of outcomes and low economic sensitivity. So that puts us in a pretty good starting position to deal with volatility in the market. So for example, in the more recent past with some of the tariff discussions that came about, or some of the worries around DeepSeek and the pace of AI investments, the portfolio did an actually very good job of protecting to the downside in those environments. And it was similar in 2022 when there started being more inflation and interest rate expectations on the rise, and that led to a general decline, a fairly sizable decline in the broader equity markets. And in those types of environments, we're generally able, because of the profile of companies we're looking at, to protect to the downside quite well. And when those opportunities come up, when there's a lot of volatility in the market, then that allows us to try and take advantage of those and buy some higher quality companies that are really able to help the portfolio deliver on its 10% objective per year.
We have seen a backdrop of persistent policy uncertainty that's coupled with geopolitical risks. Yet, the S&P 500 is up almost 10% to date. Andre, what's your view of the market at this point?
Well, we don't try and predict what the market is going to do in the short term or the medium term. All we look at is the range of outcomes that we might see. From our perspective, it does look like the market is pretty sanguine about some of the risks out there, like geopolitical risks. There's a lot of policy uncertainty and inconsistency coming out of the US in particular, and some worries around public deficits and inflation and interest rates, as well as AI and the pace of investments that are occurring there. Will that be sustainable? Will the productivity gains from those investments deliver as people are hoping to? So there's quite a wide range of outcomes, and the market seems fairly relaxed from our perspective around those. But one thing we can all agree on is that the performance of the broader markets has been very narrowly defined by AI. We just don't have that much diversification across the broader markets anymore. It seems like a very concentrated market on that one theme. But what we do know as well is that that narrowness has created a lot of attractive opportunities outside of the tech sector. And so in a lot of the areas that we look for to invest in, the relative valuations at which we can buy these companies is very attractive at this point in the cycle. And the relative valuation of our portfolio versus the broader market is actually at a historic low. So that narrowness leaves us quite excited about our own portfolio and its ability to deliver the type of returns that we're trying to do, and to also protect investor capital in the process.
So you can see that, or like you shared, the current leadership in the market is relatively narrow. So with the investment approach that you're using for this fund, how does it actually complement, investors' portfolios?
Given the type of investment style we're trying to prosecute, we've historically had very low correlation with the broader markets, yes, and increasingly so in the last few years as those broader markets have become more dominated by the tech giants. So I think we've done two things from an overall portfolio perspective, or a client's portfolio perspective, is one, diversify versus broader equity holdings, and also in difficult periods do a pretty good job of protecting capital to the downside. And I think that's the greatest role that our portfolio plays, is that in addition to delivering on that objective of 10% returns over the long term, that we've add a good level of diversification to investors' holdings.
As markets evolve, do you think your investment style will change? And how would you adapt it to this new multipolar world?
Well, we're always going to be guided by the same 4 principles that we talked about earlier. We're going to look for resiliency in the companies we invest in. We're going to look for quality management teams behind them, moderate prices, and our 10% value creation objective. in this new multipolar world, that's a lens through which we have to judge resiliency and durability of our companies, and always something we take into account in our research in evaluating whether a company is fit for investment in the durables enterprises strategy. So that won't change. Our North Star will always remain the same, is to find that level of value creation and do it in a way that delivers a portfolio that has less risk than the market. And these new factors that are popping up, like deglobalization and the splintering up of supply chains and geopolitical outcomes that might be different, is something we always take into account in our research on companies to judge whether they pass that resiliency test that we put them through.
Thank you so much, Andre, for sharing those insights with us today. It's clear that the durable equity strategy is indeed designed with resilience in mind, focusing on quality companies that can deliver long-term returns while weathering market uncertainties. For our listeners, if you'd like to learn more about the United Global Durable Equities Fund and how it might fit into your portfolio, please connect with me or find an IGM advisor through the link below.
Okay, with that, we have come to the end of the episode. Thank you, Andre, for sharing with us about the fund. Thank you, Adeline, for hosting with me. And without further ado, we'll see you in the next episode. Bye.